Good morning, everyone. First of all, a really warm welcome to each and every one of you. It's been 1 year since the last event when I was here, and I must say quite a lot has changed. Since then, last year we were talking about the Bitcoin ETF approvals in the US, and in 1 year, I must say the maturity of the digital asset and blockchain ecosystem has increased quite a lot. And if there was one word that gained quite a lot of attention, specifically in the last 1 year, was real-world asset tokenization. To just discuss this important topic, we have a group of experts. So without further ado, I would like to proceed to the introductions, and we'll start with you, Robby.
Hi, I'm Robby Young. I'm CEO of investments for Animoca brands. So I focus on the investing side of our business, where we actually are, I guess you could call it a corporate VC. We've invested in about 600 companies across the Web3 space, everything from consumer to institutional to infrastructure. We're also an active builder in the space, again, both in consumer and institutional, making everything from entertainment products to stablecoins.
Timo?
Yeah, Timo, co-founder of Swarm. So we're an infrastructure layer for RWA tokenization. And so we basically built blockchain functionality and protocols for issuance and redemption of non-native digital assets. And then we also built, because they're non-native, we also built the layer that allows people to verify the underlying assets. So, when you have a Bitcoin, you know that the Bitcoin is, if it's in the wallet, you have it, right? With RWAs, it's a little bit different because they're not natively digital. So therefore, you need to provide a kind of a provenance path or proof of reserve function. So we built that too. And then the third thing we did was we saw a gap in the market for trading RWA specifically. So we saw that there were some, specifically if you want to do like atomic swaps and peer-to-peer trading, we saw that there were some compliance features that were missing. So we built like a compliant trading protocol for RWA assets.
Marion?
Marion Laboure. I'm a senior economist. I'm responsible for technology investment research at Deutsche Bank, and I'm also a lecturer in economics and finance at Harvard University.
Staci?
I'm the CEO of the Algorand Foundation. Algorand is a next-generation Layer 1 blockchain.
And Staci, we'll start with you. Just help us understand, because a lot of people already have an idea of what RWAs are. Just help us understand the basic concept behind real-world asset tokenization, and why do you think it's important?
Okay, how many of you have put a solar panel of any kind on your house, or have thought about it, or wanted to, or know somebody who's done that to kind of try to minimize your electricity bills? Okay, I don't know why you would do that. I really don't.
You mean because we live in the UK?
So Enel, which is the Italian utility company, it's the second largest utility company in the world, had this idea, which is, people want to offset their electricity costs, but lots of people live in the UK or Ireland, where it's cloudy. Lots of people live on the 4th floor of the apartment building, and they can't do it. And by the way, somebody's got to go to all these rooftops, clamber up there, put this big piece of glass on the roof. And Enel said to themselves, there's like fields over there in sunny places where we could put a whole field of solar panels, tokenize them, and sell to our customers little tiny pieces of that solar panel field. And the more of those solar panels or portions of those solar panels that you buy, the more that you can offset your electricity bill. And by the way, you could have a portfolio of different kinds of things. Maybe if it's sunny over here sometimes, sunny over there, other times windy over here, other times, you could get yourself some portfolio effects by having these tokenized representations of solar instead of having to put it on your roof and keep it dusted the whole time, right? That's also, of course, gives Enel economies of scale as well. So that example, that's a company that's doing this on the Algorand blockchain. That example, I think, signifies the two things that are important about tokenization. One is that it makes illiquid assets liquid, right? And we can talk more about that later on. But you might not be able to buy a $700,000 antique car or a $5 million antique car, but you might be able to buy a piece of a car as an investment. And you might get as a little perk the chance to drive it like one time a year, right? You might not be able to buy an apartment building, but you could buy a piece of an apartment building. These are all things that are done on-chain. And then secondly, and it's kind of the other side of the same coin, is that it is part of kind of financial inclusion, more broadly speaking. You know, you can't afford an apartment building, so now you can. You can't get liquidity as an apartment building owner, and so it brings kind of liquidity to these markets and gives more opportunity to middle-class, mass affluent investors.
So, Timo, we have seen quite a lot of demand in terms of RWAs, and people talk about the multi-trillion-dollar potential it has. Just help us understand a bit more in detail, which assets are seeing the most demand?
Yeah, so this has been a pretty long journey, actually. So we started in 2018, originally looking into the space, and you know, there were a lot of ideas of what should and could be tokenized. But I mean, now that you know things have matured somewhat, I would say, if you just look at raw numbers, and let's start there. Actually, private credit is the biggest category right now in terms of tokenization, but that's actually attributable to mainly 2 or 3 companies, like Figure is one of them, Maple and so forth. So I think, you know, that's like a very kind of strong number. I think they have 15 billion or so in current assets under tokenization, if you want to use that term. But then what we've seen is that, you know, the trend is more towards very well understood assets. So for us, it's been tokenizing public stocks, ETFs, assets that people are really familiar with and understand, because in some ways we're bringing kind of a new market infrastructure into the world. And in doing that, if you also at the same time try to bring something very new into the world where the investors or buyers or users don't really understand what the underlying value is, that's much more difficult. So we started with like Apple, Tesla, Nvidia, you know, all the kind of well-known assets, and that's also been later on supported by obviously Larry Fink saying that everything should be on chain if you talk about like securities and stuff like that. So I think very strong trend there. Commodities also, we created a gold product, which is slightly different from, it's very different from Pax Gold and Tether Gold, in that we actually tokenized individual gold bars together with Brinks here in London. And so if you own basically an NFT, you have the legal rights to the underlying gold bar, which is individually identified. So it's actually, you can actually claim it, which is also part of the whole idea of that, like creating trust around like, how do I know that the thing is there? Because this is non-native, right? It's non-native digital asset, and therefore it's really important to understand that, you know, I actually own the underlying thing. And one way of proving that is actually to redeem it, or redeem the equivalent value of it. So those are 2 mechanisms that we're focused on. So that's kind of on the, let's call it almost like the boring side. This is like stocks and ETFs and things like that. It's almost a bit of a no-brainer to bring that on chain. But, you know, there's some good characteristics there. Price discovery is strong. Liquidity, if you need, so, you know, you have the bootstrap problem on chain, right? So you need to build critical mass in terms of liquidity. For stocks, it's very easy because we built automation back into TradFi. So, you know, if there's a lack of liquidity on chain, we just backfill that from the TradFi markets, which for the names that we brought on chain, there's almost unlimited liquidity. So it's like, it's very easy to kind of fill the gap in terms of, you know, any liquidity that's needed, at least when the market is open, which is, you know, increasingly so going forward. And then, yeah, and then we're seeing some new things like new things that are enabled by blockchain, which weren't really possible before, like streaming payments for music royalties, or streaming payments for solar field yields, or streaming payments for anything that has this like continuous characteristic. Whereas before it was cost prohibitive to distribute those proceeds on a continuous basis, because it would be like, oh, we'll send you the money monthly, or even like with a lot of the funds, it's like, you know, monthly or quarterly or even biannually. So
and
I think
small amounts and small amounts.
Exactly. Yeah, good point. So small amounts, small increments, and that's like, we see that these are financial products that weren't really possible to build before in the same way, and now they're like globally available through blockchain. So I think, yeah, there's a lot of interesting stuff happening, and you know, beyond that, we have a couple of projects around carbon credits. Somebody wants to build a market for that. We provide them with the infrastructure. You know, if they're successful or not, it's up to them how they build, how successful they are in terms of building that market. But that's a category that we're seeing as well. And then we're seeing people building like specific vertical markets within, for example, real estate, and they want to use our infrastructure for that. So it's like Yeah, it's a long answer, but there's a lot going on. It's kind of the main point, and I think some of these things have reached critical mass by just using very few issuers and investors, but that allocate really large amounts of capital towards those assets, whereas some of the innovation is actually happening a little bit more kind of, guerrilla style, which doesn't have the same numbers, but like long term, I think are much more exciting because they're like doing something completely new.
And Marion, just help us understand what institutions are doing in terms of adoption of CBDCs, stablecoin, and this entire concept of tokenization.
Yeah, so as of Deutsche Bank, we are working very closely with central banks to work on it. So, for example, we are a very active member in Project Agora, which is gathering 7 central banks, including the Bank of England, the New York Fed, the ECB, represented by the Bank of France. We are also partnering with the Monetary Authority of Singapore for Project Guardian as well. And where we are seeing some interest from clients, it's bond tokenization. So we help our clients to tokenize bonds. We recently helped Siemens, KfW. And another thing where we are seeing some demand as well is custody solutions, where we are partnering with Taurus to offer crypto custody and asset tokenization. To answer your second question, Bilal, on stablecoins, yes, we've seen some exponential growth, clearly. So if I look just at the latest 5 years, in 2020, the market cap of stablecoin was around $20 billion. Now it's around $240 billion, so a big exponential growth. And what is very interesting is, yes, Tether dominates the market, but if you look at the 80%, if we look at all the stable coins, 80% in terms of volume are pegged to the US dollar, which represent over 99% of the market cap for stable coins. So the US is clearly advocating for stable coins, but it's also correlated to the US interest. Tether is one of the big buyers of US Treasury bond in the top 15. And I don't think we'll see a US digital dollar under Trump. He's been pretty vocal that he's not a big fan of CBDC. In Europe, it's very different. I would be surprised if we don't see a digital euro here, given that it seems that Christine Lagarde is pretty optimistic on it, despite the fact that we don't have any clear view whether or not we'll get a digital euro, but I would be surprised if we don't have a digital euro. And one country, obviously, which is pretty quick, it's China with the digital yuan. They have been piloting the digital yuan since 2020. They've been researching it since 2014, and they've made significant progress on it.
And Robby, we often talk about institutional involvement in this space, but we need to understand that it was the passionate founders who built this ecosystem initially, at least for the first decade, and they're still building. You interact with quite a lot of founders in this space. What are they thinking in terms of real-world asset tokenization or stablecoin space?
Sure. So I think we entered Web3 actually through that passionate builder doorway, and particularly with native digital assets, because we were a games company originally. And so the original thing that attracted us to blockchain was essentially this idea of tokenizing game assets, because the gaming market is a $230 billion industry, and we felt that all assets in video games and collectibles should be tokenized. So that's kind of how we started. And I think, the thing about tokenization that I love, and that kind of links both the institutional and the consumer adoption, in my opinion, is this idea of interoperability, because I think that's the real superpower of blockchain to begin with. It's the idea that once you start tokenizing these things, it's not just that you can have, fragmented ownership, but it's the idea that these tokens can then interoperate amongst each other, meaning that if you have a decentralized exchange, you can exchange anything. You can exchange, Pokemon cards that have been tokenized with solar credits that have been tokenized with, bizarre combinations of assets. And what you're doing essentially is you're unlocking the power of those assets and turning them from something that had maybe only one purpose in life to something that has multiple purposes in life. And so we think a lot about this because obviously we're invested across all different kinds of sectors and different asset classes. And so I think this interoperability and this interchange, the idea of using infrastructure to allow, interoperability between various blockchains through zero-knowledge proofs and other things, I think is really important because it's not just about the individual categories that we can tokenize, because I think the point of this panel is that actually RWAs is kind of talked about as if it's a subject matter. It's actually the whole thing, right? This is all of what we're doing in Web3 is tokenizing everything. So this is actually really the heart of the discussion, in my opinion.
And staying on the tokenization topic, what are the top 3 areas, key areas of growth you see going forward in the coming years?
So I think a couple of things. Obviously, those of you in the room in financial services, which is probably everybody, will go with AUM from top down. So as you said, things like private credit and things like derivatives, et cetera, because obviously that's where the biggest chunks of assets are. I think also you can't forget about the consumer and the retail story, because that opener that Staci was talking about with respect to things like solar credits and stuff, these are things that affect individual consumers, and that's going to be part of the mass adoption. I think as Timo was saying, a lot of the activity now is especially with large volumes of financial transactions from a few very large players. Whereas the flip side is also we have huge adoption, for example, of stablecoins in terms of volume of transactions actually happening throughout developing economies around the world, that kind of offsets those very large transactions from the BlackRocks of the world.
Timo?
Yeah, well, I think, again, like stablecoins will just continue to grow. I mean, it's just unbeatable to have a digital representation of not only the dollar, but also, additional currencies. So I still think that that's going to continue to grow very rapidly. And I mean, in fairness, that is the largest real world assets category because they're all backed by, bonds or paper of some sort. So it's really the native RWA, if you will. What we're seeing specifically for us, there's a lot of demand from different blockchains now that kind of Larry Fink has kind of approved the tokenization of stocks and ETFs and everything else. So there's like a huge proliferation across different blockchains. So layer 1s, layer 2. So everybody now wants to have stocks, ETFs, and all these assets on their chain specifically. So today we're on Ethereum, Polygon, Arbitrum, Base so far. But we have the same handful of projects ongoing that want to build out the same set of specifically like well-known securities, because it's kind of a no-brainer, and most chains want to have that, with a few exceptions. There are more AI-focused, such as Near and so forth. So that's very near term. Just get the stuff out there, create critical mass within the ecosystem. And then the kind of the midterm, I think, is actually some of these things that are more innovative, like the music rights trading, or the Pokemon cards, all the things where there's a massive appeal from a retail or a mass market audience. I think there's a lot of growth there in terms of just having the ability to exchange these things or do things with them on chain. And then the third, and actually where we started like 6 years ago, is like tokenization of private funds and secondaries, which we thought, like coming out of that industry ourselves, we thought like, okay, this is the big one. This is like all the liquid assets that are out there that need liquidity, or at least some way of being traded without having 5 lawyers involved and a bunch of wires that take time and go wrong and whatever. That's a category. But that, I mean, obviously with the LPAs and all the rest of it, it has a very slow turnaround time. So in 10 years, yes, we will see a lot more tokenized private funds and secondaries, but it's a pretty slow process because of the agreement structures that are effectively inhibiting some of that growth.
Marion?
Yeah, I fully agree with what you said, Timo. Stablecoins, and clearly when we look at the number of transactions, that's very impressive. I mean, to just if we look at just the number of stablecoin transactions, it's over Visa and MasterCard these days, which is outstanding, by the way. And apart from that, as an institutional, I will answer your question, we are seeing some demand in terms of bond tokenization because it's quicker, faster, lower fees, 7 days a week, automatic settlements, so clearly bond tokenization. We are also seeing some interest from illiquid asset. It's a key asset, by the way, for real world asset. And I'm thinking especially to real estate, given that it's a mass market and it's very liquid. And the second one is private equity. It can lower the minimum ticket, so it's quite an important space for us as well.
Yeah, Staci?
Yeah, I guess I'll give 4 sort of archetypal examples. One is securitization vehicles, something that is, of course, near and dear to everybody's heart in this room. Before I start, though, as an aside, tokenization is nothing unless you have the other side of the trade, which is digital money. You have to be able to do an atomic swap on-chain so that there's no counterparty risk, there's no credit risk around that. So when you have your tokenized, we tokenize an Aberdeen money market fund. But the important second leg of that trade is a company regulated by the Dutch Central Bank in Belgium it's called Quantos, and it's a digital euro. So if you take that sliver of a money market fund, you have to be able to swap it for digital money immediately in what's called an atomic swap, and that can only be done on-chain. And tokenization doesn't mean anything without that money side also being on-chain, I would assert. So if I start with kind of 4 examples, I'll start then with the money example first. Why is it that your cash is not always earning yield for you? Why is that? Why do we tolerate that? I should be able to take that tiny sliver of an Aberdeen money market fund, and I should be able to hold it in my wallet, and when I go and I should be able to earn yield from my Aberdeen money market fund until I go into a cafe and I buy a cup of coffee, and when I get my latte, then Starbucks can start earning yield on my tiny sliver of my, what's a Starbucks latte now? $17? My $17 Starbucks latte, they can then earn yield on that. So that's the first thing, you have to think about this very futuristically. The second example is in these securitization vehicles, right? There are a lot of intermediaries in securitization vehicles. You take a mortgage securitization, all that's happening there is a waterfall, right? A waterfall of investors. Some are getting the principal first, some are getting the interest, some take the first loss, some take the second. There's calculation agents that figure all of that out. No offense to any of the calculation agents in the room, right? But this can all be automated with smart contract-based money, programmable money, and tokenization of these underlying assets, right? Calculation agents, paying agents, right? All of these guys, they take 3 to 30, I don't know how many basis points off of 3 to 4 basis points, let's call it, off of a mortgage. And for $1 million mortgage, that could be $30,000, $40,000, right? It's real money. The third archetypal example is in, as I was saying earlier, illiquid assets, right? Having rental income is a very important way to diversify your portfolio income. I'm not talking about an in-law suite over your garage, right? I'm talking about a small apartment building. But, middle-class investors, they're not going to buy an apartment building, but they could buy a part of an apartment building. So there's a company building on Algorand called Lofty AI, and for as little as $50, you can be an owner of a rental property, right? And what do you do as an owner of a rental property? You go to the Lofty AI website, where, by the way, it doesn't say Algorand, it doesn't say tokenization, it doesn't say blockchain anywhere on this website, but you get, the rental history, the tax records for the area, the property manager. They form little DAOs around each property, and they get rental income, to your point earlier, liquid, right? You don't get your rental income at the end of the month. You get it every day, your percentage of your ownership in that property. And then the last example I'll use is in consumer. So the relationship I would argue that you hate almost the most is with your airline, right? Because if you don't want to take a trip that you booked, you have to go within a year, you have to take the same route, you get paid, you get fined $70 or whatever it is. But what if you didn't want to take that trip, and you could sell that ticket because it's tokenized to somebody else on a secondary market. And so there's a company called Travelex that has tokenized airlines. They're now on their 4th airline partnership. And if you go to the airline that they started with, Flybondi, again, you don't see Algorand, you don't see Travelex, you just see airline tickets for sale, right? Now, that market is not very liquid, right? Like, people aren't trading like their exact airline legs all over the place. But the airline can go to you and say, oh, you know, you bought this ticket to Minneapolis, you paid $100 for it, it's tokenized. Would you like $130 to not go to Minneapolis that weekend and go the next weekend? Because see, there's this like Taylor Swift concert in Minneapolis that weekend, and we can sell that ticket for $400. It's like a win-win, but this stuff is only possible with these tokenized assets and tokenized on-chain, on Algorand.
Although we have just a couple of minutes left, I want you to shed some light on which regions are taking a lead, because we have seen like a massive change in tone in the US. We have seen Middle East coming up as well to be a digital asset blockchain hub. In your opinion, we'll start with you, Robby, which regions are taking a lead, for example, in the next coming years?
Okay, so I'm going to put in a plug then here for Hong Kong, which is our home, just because we're working on the Hong Kong dollar stablecoin there. And I think that we've got quite a good regulatory framework, at least for amongst the various financial centers in Asia, to be launching that in Hong Kong. Obviously, we've talked about some of the other jurisdictions, and you mentioned the UAE, for example, and the US.
Timo?
Yeah, we're regulated, filed a prospectus in Europe with ESMA, so we have basically a European focus for the public stocks and ETFs products. And then for the gold product, it's emerging markets, I would say, that we see kind of a lot of action. And then, we left the US. Philip and I started the company in Palo Alto in 2018-19. We left the US. It was impossible to get anything done. So we moved to Europe, and now we're going back into the US.
Marion?
So on our side, we are quite active, and we are working quite a lot with the Monetary Authority of Singapore, with the Project Guardian. We are also quite active with the BIS in Switzerland, which represent quite a good private-public partnership.
Staci?
I would just like to remind President Trump that we are a U.S. company, that President Biden definitely did not win the presidential election 4 years ago. We have always been a U.S. Republican blockchain, and that we would fit quite well into the strategic token reserve should there ever be one. But, and yeah, America first, baby.
On that note, thank you so much for your time, and thank you everyone for staying with us. Thank you.